All right, get ready to dive deep, deep into Canadian self-employment taxes with us today.
That's right. We're going to be talking all about how to really make the most of those deductions. We'll be demystifying capital gains.
Yes.
And making sure that you are in absolutely tip-top shape when tax season rolls around.
Perfect. And to help us break it all down, we're going to be looking at T4002-23E.pdf.
That's right. The Canadian government's very own guide to self-employment taxes.
So consider this your express lane to becoming a tax master.
You know, and a lot of people think that this stuff is only for seasoned business owners.
Yeah.
But honestly, whether you've been an entrepreneur for years or you're just starting out and testing the waters,
Right.
understanding these tax concepts can make a huge difference in your financial success.
Absolutely. So let's not waste any time and jump right into it. Who exactly is this tax guide for?
So this guide is really your go-to resource if you're a Canadian sole proprietor or if you're in a partnership.
Yeah.
Especially if you're running a business or a professional practice.
Okay.
Or if you're involved in commission, farming, or fishing activities.
So that means if I've incorporated, this isn't the guide for me.
Exactly. If you have an incorporated business, you'll want to take a look at Guide T4012.
Okay.
And if you're dealing with trusts, then Guide T4013 is going to be a lot more helpful for you.
Got it. But for all those sole proprietors and partnerships out there.
Stick with us.
All right, let's talk shop. Now, I've personally always been a bit confused by this whole fiscal period thing.
Okay.
Can you break that down for me?
Sure. So think of a fiscal period as like your business's chosen timeline for reporting its finances.
Okay.
It's basically the time frame that you're using to keep track of your income and your expenses.
Got it.
And, you know, most self-employed individuals, they use December 31st as their year end.
Right, that makes sense.
But there can be some exceptions.
Interesting. So if my business operates on a different schedule, let's say, for example, from June to May, I would have to do a little extra work when it's time to file my taxes.
Exactly. You'd use something called Form T1139 to reconcile your business income with the calendar year for tax reporting.
Okay, so it's all about making sure everything lines up.
Yeah, exactly. Lining up all your financial stars.
All right, that makes sense. Yeah. Let's talk about the different ways to report income.
Okay.
What's the difference between the cash method and the accrual method?
All right, so this is where things can get a little bit strategic.
Okay.
When you use the CAS method, you report your income when you receive it.
Okay.
And you deduct expenses when they're actually paid.
Sounds pretty simple.
It is. Simple is good, especially when you're first starting out.
Right.
But as your business starts to grow, the accrual method might end up being a better fit for you.
Okay, why is that?
Well, so with accrual, you report income when you've earned it.
Okay.
Even if the payment hasn't actually hit your bank account yet.
Interesting.
And in the same way, you deduct expenses when you incur them, not just when you pay the bill.
So it's all about having a more accurate picture of how your business is doing financially.
Yeah, exactly. It's like a real-time snapshot of your finances, which is really important for making good decisions about your business.
That makes a lot of sense.
Right.
So choosing the right method really just depends on what your business needs are. Now, is it possible to switch between those methods if you need to?
Yes, you can, but there are a few things you have to do first.
Okay.
If you're switching from accrual to cash, that's pretty straightforward. You can just make that change on your next tax return.
Easy enough.
But going from cash to accrual, that requires getting permission from the CRA.
Oh, okay. So it's not a decision to be made lightly.
Right.
But hey, let's talk about something that I think we can all relate to.
What's that?
Keeping those receipts organized.
Oh, yeah.
Is that really that important?
It's super important. Not only is it a legal requirement here in Canada.
Oh, wow.
But it's really like you're building this financial fortress around your business.
No.
Good records are going to be your best defense if you ever get audited.
Right.
They can really help you to secure loans. And they give you this crystal clear view of your income and expenses.
Yeah, no more shoebox accounting.
Exactly.
But what happens if my records aren't exactly, the best?
Well, let's just say that the CRA might not be too happy about that.
Oh, no.
You could end up facing some penalties, having expenses disallowed.
Yikes.
Or even having your income determined using methods that aren't as favorable to you.
Okay, so good records are really, really important.
They are.
So what do good income records look like?
Well, for every income entry, you want to record the date, the amount, and the source of that income. Yeah. And you've got to make sure that you have the original documents to back it all up.
Okay, so we're talking about things like sales invoices, cash register tapes, bank statements.
Exactly. All that good stuff.
Got it. And is it the same idea for expenses?
Absolutely. Keep all those receipts and invoices organized. And make sure that they show the date, the vendor's details, what you purchased, and how much GST or HST was included.
Got it. A little bit of effort up front can save you from a big headache later on.
Oh, yeah, definitely.
Okay, no more crumpled receipts hiding in my pockets. Let's talk about something that's been making a lot of noise in the real estate world these days.
Okay.
Flipped properties.
Yeah.
I hear there have been some pretty big changes to the rules recently.
You heard right.
Okay, fill us in.
So, effective January 1st of this year, 2023, the rules for those quick turnaround real estate deals, they've changed significantly.
Okay.
Now, if you own a property for less than 365 days before selling it, it's considered a flipped property.
Okay, and why is this distinction so important?
Well, because any profit that you make from flipping a property is now considered business income, not a capital gain.
Wow. Well,
And if you end up losing money on the deal, you actually can't deduct that loss from your other income.
oh, so those quick flips might not be as lucrative as they used to be.
Yeah, it really comes down to planning carefully and understanding how the taxes will work out.
Right.
Now, there are a few exceptions for certain life events.
Yeah.
Things like death, disability, or relationship breakdowns.
Right.
But you'll definitely want to check out Guide T4037 to get all the details.
Okay, noted. So flipping houses definitely requires more strategic thinking now than it used to.
Yeah.
What about installment payments?
Okay.
Is that something that self-employed people need to worry about?
Well, if you end up owing a lot in taxes,
Mm-hmm.
the CRA might ask you to make regular installment payments throughout the year.
Right.
That way, you avoid getting hit with a massive bill come April.
Makes sense. It's like a pay-as-you-go system for your taxes.
Yeah, exactly.
So how would I know if I need to be making those payments?
The CRA will usually send you a reminder
Okay.
with a calculated installment amount.
Got it.
And that amount is based on your income from the previous year.
Okay, good to know. What about employment insurance?
Okay.
Can self-employed people take part in that?
Yeah, you can definitely choose to contribute to EI.
Okay.
And that can provide a bit of a safety net if you ever lose your job or need to take time off for certain life events.
Okay, so how do I sign up for this self-employed EI magic?
It's super easy. You just register with Service Canada.
Okay.
And then your EI premiums are calculated right on your income tax return. And you pay them when you file your taxes.
All right, and are those premiums a big expense?
Well, don't forget, you can actually claim a non-refundable tax credit to help offset that cost.
Oh, okay.
It's a provincial or territorial credit.
Got it.
So make sure you claim that when you file.
Okay, good to know. All right, let's move on to the always popular GST-HST.
Okay.
How does that work for self-employed individuals?
So the magic number here is $30,000.
Okay.
If your worldwide gross revenue from taxable supplies reaches that amount in a single quarter, or over 4 quarters in a row, you're required to register for GST-HST.
So if I'm just starting out and I'm below that threshold, I don't have to worry about it.
Not necessarily you don't have to register, but you might actually choose to voluntarily, especially if you want to be able to claim those input tax credits,
Right.
which can really help to reduce your overall tax burden.
Interesting. Are there any exceptions to this rule?
Yeah, there are a few. For example, if you're running a daycare out of your home,
Okay.
you're generally exempt from registering for GST-HST.
Got it. So no need to stress about that one if it's your only business activity.
Exactly.
All right, let's talk about the mysterious capital cost allowance, or CCA.
Okay.
What is that all about?
So think of CCA as a way to spread out the cost of depreciable property over its useful life.
Okay.
You can't deduct the full cost all at once,
Right.
but you can deduct a portion of it each year through CCA.
And what exactly do we mean by depreciable property?
We're talking about the things that lose value over time. Things like buildings, vehicles, computers, even office furniture.
So instead of taking one big hit up front, I can spread out the deduction over several years.
Exactly. Now, there are a few little things to keep in mind with CCA.
Okay, like what?
Well, if you're part of a partnership,
Yeah.
you can't claim CCA on partnership property individually.
Okay.
It has to be claimed at the partnership level.
Got it. No double dipping.
Yeah.
Anything else?
There's also the half-year rule.
Okay.
Which means you can usually only claim CCA on half the value of new additions to a particular asset class in the year that you buy them.
Right.
And then there's the immediate expensing incentive, which is helpful for folks just starting out. If you're eligible, you can deduct the full cost of certain properties up to a certain limit in the year you get them.
Okay, so CCA has a few different things to keep in mind.
Yeah, it's a bit of a balancing act.
Now, I have to ask about vehicles.
Okay.
They always seem to have their own special set of rules.
They do. Keeping detailed records is super important when it comes to motor vehicle expenses.
Right.
You need to know your total kilometers driven and how many of those were specifically for business.
So I can't just claim all my driving expenses just because I sometimes use my car for work.
Unless you want to get a visit from the taxman? No, you have to calculate the percentage of your driving that was strictly for business.
Okay.
And have meticulous records to back it up.
Okay, that logbook is my new best friend.
It should be.
What about leasing costs? Are those treated differently?
They are. There are specific limits for leased passenger vehicles.
Okay.
And those limits apply even if you're sharing the lease with someone else.
Got it. Vehicles can be tricky.
They can be.
But I think I'm starting to get the hang of it.
Good.
What if I'm one of those lucky people who gets to work from home?
All right.
Can I deduct expenses for my home office space?
You can, but there are some rules.
Of course.
To claim those home office deductions, the space has to be used exclusively for earning business income.
Okay.
And also regularly used for meeting with clients.
So no deducting my entire apartment just because I answer emails from my couch sometimes.
Not quite. The key is to have a dedicated workspace that's used just for business.
Got it. No multi-purpose spaces.
Right.
So what kinds of expenses are eligible for the home office deduction?
Well, you can deduct a portion of your maintenance costs, property taxes, mortgage interest, and even CCA on the part of your home that's used for business.
It's like I'm claiming a little piece of my house for my business.
Yeah, exactly.
I like it.
What about non-arm's length transactions? What are those?
This is where things get a bit interesting.
Okay.
When you buy depreciable property from someone you have a close relationship with, like a family member or business partner,
right,
there are special rules for figuring out the cost for CCA.
So if I buy a used laptop for my sister, that would be a non-arm's length transaction.
Exactly. And those special rules can impact how much CCA you can deduct.
Okay, so family deals can get complicated. Yeah, it's good to get some professional advice if you're not sure.
Got it. Now, what about capital gains? Do those apply to self-employed people?
They do.
Okay.
We'll talk more about those in a little bit.
Okay.
But if you're looking for a really comprehensive guide to capital gains, you'll want to check out Guide T4037.
Will do. I know that farming has a unique set of rules.
Right.
So what do farmers need to know about capital gains?
Well, one really common scenario is when farmers sell farmland that includes their principal residence.
Okay.
There are two ways to calculate the capital gain on that.
Okay.
You can do it separately for the residence and the farm properties, or you can calculate the total gain and then subtract $1,000 plus an extra $1,000 for every year after 1971 that the property was your main home.
So farmers have a few options when it comes to figuring out those gains.
They do.
And I think you mentioned earlier that they might also be able to deduct some previous restricted farm losses from capital gains on farmland.
Exactly. Those are kind of like a rainy day fund for farmers.
Right.
These are losses that couldn't be fully deducted when they happened, but you can use them later on to offset future farming income or capital gains.
Okay, so those losses aren't a total wash.
Nope, you can use them strategically.
I like it. And speaking of strategic, there's that special capital gains exemption for qualified farm or fishing property, right?
Yes.
So if you meet certain conditions, like owning the property and actively using it in a farming or fishing business, you might not have to pay taxes on a portion of the profit when you sell it.
Exactly. It's a lifetime exemption, and there are some specific conditions.
Can you remind us of those conditions again?
Of course. So the property has to be owned by you, your spouse, your child, or even a family farm partnership and corporation.
Got it.
It needs to be used mainly in a farming or fishing business here in Canada. And you have to be actively involved in the business on a regular and ongoing basis.
No absentee landlords allowed.
Nope.
So just owning a farm doesn't automatically mean you qualify for the exemption.
That's right.
You got to be hands-on.
You do.
Now, what if you're thinking of passing your business down to the next generation?
Okay. Yeah.
What happens then?
Well, that's where those intergenerational transfers come in.
Right.
You can actually defer paying taxes on those capital gains.
Oh, wow.
By transferring your farm or fishing property to your child.
Okay.
As long as they're a resident of Canada and the property was being actively used in the business.
So it's like passing on a legacy.
Yeah.
Along with some potential tax benefits.
Exactly.
Before we wrap up this section, I want to circle back to those tax avoidance transactions.
All right.
Is this something that everyday self-employed individuals should be concerned about?
You know, it's always good to be informed, even if you're not intentionally trying to avoid paying taxes.
Right.
Some transactions could trigger reporting requirements, even if they're not technically considered tax avoidance.
Okay, so what should we be looking out for?
Any transaction that's really complicated or doesn't have a clear business purpose, or if it seems like it was designed mainly to reduce your taxes, you should definitely be extra careful and probably get professional advice.
Good advice. Now, before we move on, what about those digital services that the CRA keeps talking about?
Okay, so my account and my business account, those are like your personalized tax dashboards. You can use them to make payments, file your returns, track your files, and even request relief from penalties or interest, all from your computer.
Sounds pretty convenient. Embracing the digital age could make tax time a little less stressful.
Definitely.
What about taxpayer relief? What happens if I make a mistake or miss a deadline?
Don't worry. The CRA has different options for relief from penalties and interest.
Okay.
You can request relief online through those digital services we just talked about.
Okay.
Or you can use Form RC 4288.
Got it. It's good to know that there's help available.
Yeah, they really are trying to make things easier for us.
That's great. All right, that's it for part 1 of our deep dive into Canadian self-employment taxes.
Great.
We've covered a lot of ground.
We have.
But there's still so much more to explore.
There is.
So be sure to tune in for part 2, where we'll uncover even more tax secrets.
All right.
And strategies to help you keep more of your hard-earned money.
Sounds good. Welcome back to our deep dive into the world of Canadian self-employment taxes.
All right, so last time we talked about a lot of the basics.
Yeah, we covered a lot of ground.
But I know there's always more to learn when it comes to taxes.
Oh, absolutely.
So let's zoom in on something I think a lot of self-employed people have to deal with.
Okay.
Using their personal vehicle for business.
Yeah, that's a great one. We talked about keeping really good records for those motor vehicle expenses, but there are some things that are a little different depending on what type of vehicle you're using.
Okay, so let's say I'm a freelance photographer and I use my car to get to photo shoots or to meet with clients. What are the key things I need to be tracking?
So first, you need to figure out if your car counts as a motor vehicle or a passenger vehicle for tax purposes, because that's going to affect the deductions you can claim.
Got it.
For things like CCA, interest on a car loan, and leasing costs.
Right. And just to refresh our memory, a passenger vehicle is basically your typical car, a station wagon, or even some pickup trucks.
Yeah.
That are mainly used for carrying people.
Exactly. Now, if you're using a passenger vehicle for your business, there are limits on those deductions.
Okay, so that means I can't just deduct all my car expenses
right.
just because I drive to meet a client every once in a while.
I wish it were that easy, but no.
All right, so how do I figure out what I can deduct?
You have to determine what percentage of your driving is specifically for business.
Right, and that's where that logbook comes in.
Exactly.
So I need to track both the total kilometers I drive and the kilometers I drive just for business.
Right. That's right. And don't forget, even those little trips, like going to the bank to deposit a check, or running out to grab some supplies.
Got it.
Those count as business kilometers, too.
All right, so let's say I've got my logbook, and I've calculated that percentage.
Okay.
What's next?
Now you got to factor in the capital cost of your vehicle.
Okay.
Which is basically the price you paid for it, plus any GST or PST, things like that.
Okay, so that's where the CCA comes in.
You got it. Remember, you can't just deduct the whole cost of the car all at once.
Right.
You deduct a portion of it every year through CCA, and the amount you can deduct depends on your vehicle's classification and the CCA rate for that class.
Right, and there are those limits on how much you can claim for passenger vehicles.
That's right. There's a set limit on the capital costs that can be used to calculate CCA for passenger vehicles, and it changes every year, so make sure you're using the right amount for the current tax year.
Okay, so there's a bit of a formula to figure out the CCA for vehicles.
Yeah, there are definitely a few moving parts.
What about if I'm leasing a vehicle? Is that treated the same way?
It's similar, but there are separate limits for leasing costs.
Okay.
And just like with the CCA, those limits apply even if you're sharing the lease with someone else.
Got it. All right. Vehicles and their expenses.
They can be a bit of a headache.
But I think I'm starting to understand it a little better now.
I'm glad to hear it.
Now let's switch gears for a minute and talk about another situation a lot of self-employed people find themselves in.
Okay.
Working from home.
Oh, yeah. So many people do that now.
Exactly.
Right.
We talked earlier about the general rules for deducting those home office expenses.
Right.
But are there any specific ones that people often forget about?
You know, one that people often miss is claiming CCA on the part of their home that they use for their business.
Oh, interesting. So if I own my home and I have a dedicated office space, I can claim CCA on that.
You can, but it's important to remember that if you claim CCA on part of your home, it can actually affect your capital gains when you eventually sell your home.
Oh, how so?
Well, when you claim CCA, you're saying that part of your home is being used for business.
Right.
Which can reduce the amount of your principal residence exemption.
Oh. Well.
And that exemption can help you save a lot on taxes when you sell your home.
So it's like a trade-off between deducting those expenses now and potentially having to pay more taxes later.
Exactly. You got to weigh those options carefully.
Right. Makes sense. Now, speaking of weighing options, I wanted to touch on the different income reporting methods for farmers.
Okay.
Can you remind us about the cash versus accrual methods?
Sure.
And how those apply specifically to farmers?
So farmers actually have a bit more flexibility than other self-employed individuals.
Okay.
They can use the cash method for their farming activities, but they have to use the accrual method for any other business activities and for GST/HST purposes.
So let's say I have a farm and I also sell homemade jams at the farmer's market.
Right.
I would need to use different methods for each of those.
Exactly. You'd use the cash method for the farm.
Okay.
And the accrual method for the jam sales.
Got it. And I'm guessing that even if you're using the cash method for farming, keeping accurate records is still super important.
Oh, absolutely. Always. Always keep good records no matter what.
Okay. What about that optional inventory adjustment that farmers can make?
Ah, yes. That's a great tool for farmers who are using the cash method. It basically lets them include part of their ending inventory value in their income for the year, which can be really helpful for managing those ups and downs that farmers often face.
Right. It helps to kind of smooth out their income.
Yeah, exactly. There are specific rules for calculating the adjustment, but essentially you value your ending inventory. And then you choose an amount to include in your income for the year between the mandatory adjustment based on your purchased inventory costs and the fair market value of all your inventory.
So farmers have some control over how much of that inventory value they include.
They do.
Now, what about losses?
Okay.
I know farming can be really unpredictable.
Yeah, for sure.
And sometimes losses are just unavoidable. So what happens if a farmer experiences a loss?
Well, that's where those rainy day fund restricted farm losses come in.
Right.
If farming is your main source of income, you can usually deduct the full amount of that loss against your other income.
Okay, but what if farming is more of a hobby for me?
Okay.
Or just something I do on the side?
In that case, you might not be able to deduct the entire loss.
Oh.
That's called a restricted farm loss.
Right.
And you can only deduct a certain amount each year.
Okay.
But the good news is that you can carry forward the rest of the loss.
Okay.
And use it to offset future farming income or capital gains.
So it's not a total loss?
No, just delayed.
I like that.
Yeah.
And speaking of capital gains, we talked about that exemption for qualified farm or fishing property.
We did.
So if you meet those conditions, owning and actively using the property for farming or fishing, you could be eligible for a lifetime exemption on some of your capital gains.
Exactly.
But there's another scenario that comes up a lot with capital gains, right?
Right.
When you transfer farm or fishing property to a child.
Yeah, that's a big one.
Okay, tell me more.
So if you're thinking about passing down your farming or fishing business, you might be able to defer paying those capital gains taxes by transferring the property to your child.
So does that mean the tax bill gets passed down too?
Well, in a way, yes, the taxes would be deferred until your child eventually sells the property.
Okay.
But there are some conditions, of course.
Like what?
Well, your child has to be a Canadian resident. And the property has to have been actively used in the farming or fishing business.
Got it. So careful planning is really important when it comes to these intergenerational transfers.
It really is. You want to make sure everything's done right.
Now, before we move on, I wanted to circle back to those tax avoidance transactions one more time,
Right.
just to emphasize how important it is to be aware of those.
Yeah. Even if you're not trying to avoid paying taxes on purpose,
Right.
there are certain transactions that can trigger those reporting requirements.
Okay, so what are some of the red flags we should be looking out for?
Anything that's overly complicated
Right.
or doesn't have a clear business purpose,
Uh-huh.
or if it seems like it was designed mainly to reduce your taxes,
Right.
those are all things that should make you pause and maybe talk to a professional.
Good advice.
Mm.
Speaking of professional advice, are there any other resources out there that self-employed people should know about?
Oh, definitely. The CRA's website has tons of great information,
Mhm.
guides, fact sheets, videos, you name it.
Right.
And of course, talking to a qualified tax professional can be super helpful.
Yeah, for sure.
They can give you personalized advice and help you feel confident that you're doing everything right.
All right, so armed with knowledge and maybe a good tax advisor by their side, self-employed individuals can navigate those tricky tax waters a little easier.
That's right. Knowledge is power.
It is.
And staying informed about those tax rules can make a big difference for your business.
Absolutely. All right, let's take a quick break and then come back for the final part of our deep dive, where we'll explore even more tax-saving strategies.
Sounds good.
All right, welcome back to our final deep dive into Canadian self-employment taxes.
We've made it to the last stretch.
We have. We've covered a lot.
Definitely a lot of ground.
But we saved some of the best for last.
That's right.
All those juicy deductions and credits.
Those ones that everyone wants to know about.
Exactly. The ones that can make tax season a little less painful.
Well, who doesn't like saving some money? We're all about maximizing those tax savings.
For sure. So let's get right to it.
All right.
What's first on our list of tax-saving gems?
Let's talk about meals and entertainment. This is one where a lot of people get confused.
Yeah, I can see how that would be tricky.
Yeah.
I've heard stories of people trying to claim all sorts of things as business expenses.
Like those fancy dinners.
Yeah, exactly. Like trying to write off concert tickets.
Well, the CRA has rules in place to prevent that.
Right, of course.
You can deduct some meals and entertainment,
Okay.
but there are some limitations.
So break it down for us. What are the key things to keep in mind?
The most important thing is that those meals and entertainment have to be directly related to earning your business income.
Okay.
So if you take a client out to lunch to talk about a potential project,
Yeah.
that's generally going to be deductible.
Okay, what about if I just grab coffee with a colleague to brainstorm some ideas?
That one's a bit trickier. You have to be able to show that there was a real business purpose for that meal or entertainment.
Okay.
So ask yourself, would you have met with that person and had that meal if it wasn't for business reasons?
So it's really about proving that connection to your business.
Yes, exactly.
Now, you mentioned a 50% limit on these types of deductions.
Right. You can only deduct 50% of what you spend on those eligible meals and entertainment expenses.
Okay, so if I take a client out for a $100 dinner,
Yeah.
I can only deduct $50.
Exactly.
Are there any exceptions to this rule?
There are. So, for example, if you run a restaurant
Okay.
or a catering business where you're regularly providing meals to customers for a fee,
Right.
you might be able to deduct the full amount.
Okay.
And there are also exceptions for some employee events,
Right.
like holiday parties
Right.
or fundraising events for registered charities.
Got it. So it's not always a straightforward 50%.
Nope.
There are some nuances to it.
There are.
All right. What else should we be aware of?
Let's go back to those home office expenses for a minute.
Yeah, okay, yeah.
We talked about them before, but it's good to be super clear about the rules.
Right. We know the space has to be used exclusively for business.
Yeah.
But what does that actually mean in real life?
It means you can't use that space for anything personal.
Okay.
So if your home office is also your guest bedroom or your kid's playroom,
Right.
you can't deduct those expenses.
No multi-purpose spaces.
Not if you want to claim those deductions.
Okay. And you also mentioned that the space has to be used for meeting clients.
Yes, regularly.
But what if I mostly meet with clients virtually these days?
That's a good question. And honestly, the tax rules haven't really caught up with the whole virtual world yet.
Right.
It can be a bit of a gray area.
Yeah.
So the best thing to do is to talk to a tax professional and see if your specific situation qualifies.
Okay. So when in doubt, get some expert advice.
Always a good idea.
Are there any home office expenses that people often miss?
One that people often forget about is deducting part of their property taxes and mortgage interest.
Oh.
A lot of people don't realize they can claim that.
Right.
It's based on the percentage of your home that you use for business.
Okay, so if my home office takes up, let's say, 10% of my house, I can deduct 10% of my property taxes and mortgage interest.
Exactly. And don't forget about other home-related costs.
Like what?
Things like utilities, your internet bill, even a portion of your home insurance.
Okay, those can really add up.
They can.
Now, switching gears again, what about healthcare costs?
Okay.
Are there any deductions for self-employed people when it comes to healthcare?
Yes, there are. Remember those private health services plans, or PHSPs?
Right, the ones that can cover medical expenses that aren't covered by our provincial health plans.
Yeah, exactly. If you're self-employed, you can deduct the premiums you pay for a PHSP.
Okay.
But there are some limits.
Like what?
Well, the limits depend on a few things,
Okay.
like whether you have employees
Okay,
and if you've included your family in the plan.
got it.
The guide has all the details on how to calculate those limits, but the important thing is to know that they're there.
So PHSPs are a good way to manage healthcare costs
Yeah.
and potentially lower your tax
Oh,
bill.
yeah.
Are there any other healthcare-related deductions we should know about?
Don't forget about your CPP contributions.
Oh, right.
If you're self-employed, you can deduct those on your tax return.
Even though I'm paying both the employee and the employer portions.
That's right. You can deduct the whole thing.
Okay, good to know. Now, I'm a big believer in professional development.
Me too.
Always learning new things.
Absolutely.
But I'm curious, are those costs deductible for self-employed people?
They are. Investing in your skills is so important.
Yeah.
And the CRA knows that.
So what kinds of expenses can I deduct?
You can deduct things like courses, workshops, conferences,
Okay.
seminars, even industry-related books and subscriptions.
Wow, so if I'm a graphic designer and I take a course to learn a new design software,
Yeah.
that's deductible.
Yes. And don't forget, you can also deduct travel costs if you have to go somewhere for that professional development.
Okay, so things like transportation, meals, accommodation.
Yeah, all that stuff.
So investing in myself can really pay off in more ways than one.
Absolutely.
Well, before we wrap up our deep dive here, I want to emphasize something we've talked about throughout our conversation.
Okay.
The importance of getting professional advice.
Yes, so important.
These tax laws, they're always changing.
They really are. It's hard to keep up.
Exactly. What might be a great deduction one year could be totally different the next.
Right, so how do you stay on top of it all?
Yeah, it can be overwhelming.
Honestly, the best thing you can do is have a qualified tax professional on your team.
Yeah, I think that's great advice.
They can help you understand the latest rules, find all those hidden deductions, and make sure you're doing everything by the book.
It's like having a personal tax superhero
I like that.
looking out for you.
Exactly.
Well, folks, that wraps up our deep dive into the world of Canadian self-employment taxes.
It's been fun.
I hope you learned a few things
I hope so too.
and that you feel a little more confident about tackling those tax forms.
Yes, knowledge is power, right?
It really is. And staying informed can make a big difference for your business.
Absolutely.
So, big thanks to you for joining us today.
Thanks for having me.
And we'll see you next time for another deep dive into a new topic.
Sounds great.